results on the 15th, 16th and 17th, and of course we have other companies following as well. So the next 1 month or so is going to be pretty hectic. Let's bring in a special guest. We have with us Rahul Prithiani, Director Crisil Research, to talk about what's their take as to how the Q4 numbers would pan out. Rahul, thank you so much. It was interesting reading your report, which talks about the fact that this could be a mixed kind of quarter, slightly sluggish than Q3 and Q2. What's the underlying trend that we're going to see as far as this result season is concerned?
See, the underlying trend would be clearly what has happened over the last 2-3 quarters that we are seeing. The export-oriented sectors, be it IT, pharmaceuticals, they'll continue to see a strong performance. At the same time, domestic economy-linked sectors and the investment-linked sectors like construction, capital goods, as well as cement are likely to see some pressure in terms of their revenues as well as their margins.
So, time and again we've argued of the fact that is this the quarter that would see results bottoming out? Is this the quarter that would see results and the overall earnings quality bottom out, and perhaps after this we might see some improvement across the board? In a nutshell, do you see this perhaps to be the fag end of the pain that we have been witnessing for the last 3-4 years now?
As per our analysis, I think the bottoming out has actually happened in the previous quarter, and from now onward we are likely to see some improvement. However, in this Q4 there are some one-off items which are impacting sectors such as power, coal, where on the power side you saw in the last year you saw one-time recovery of previous dues for NTPC, which will kind of pull down revenues. It's also in some sectors like capital goods, where there is continued pain of last year. Last year was a much better year for the capital goods space. So if you leave out of these one-offs, as well as there was on the Maruti front, there was a merger which happened which boosted income. If you leave aside these one-offs, the trajectory is likely to be better, and over the next year or so we are likely to see growth which was overall revenue growth which was around 9% in FY14 is likely to be closer to about 12% next year. And even on the margin front, most sectors should be bottoming out, and our sense is, especially on the consumption-led space as well as the export-oriented, you should see some improvement in margins.
Your report says that revenue growth could actually dip to just 7 to 9% in Q4. What about profitability? Do you see profitability position improving for India Inc., or do you think that would take perhaps some more time?
As far as the profitability is concerned, in the current quarter we are expecting more of a flattish kind of number, and in line last 2 quarters also have been flat. And if you look at it in terms of the investment linked sectors, which is your capital goods, construction, cement, these are the kind of spaces which will see continued margin pressure and correction in margins. As far as the rest of the sectors are concerned, in terms of consumption, we should see more flattish margins, and export oriented sectors we should see still some improvement on a year-on-year basis. As you know, rupee is depreciated by nearly 14%. So it's a mixed bag.
You mentioned about investment-led sectors. I think it was last week when we saw L&T, a prominent news article suggesting that L&T could actually write off 15,000 crore worth of slow-moving orders. I spoke to AM Naik. He said that we're not going to write off, these are just slow-moving orders. Do you think this whole execution worry for the sector, for the entire investment space, could actually continue for some more time, or do you think that is also behind us?
See, clearly, compared to the depths that we saw last year, there have been a lot of policy initiatives that have taken place over the last 12 to 18 months. So going forward, we are likely to see some improvement on the back of that, but a real improvement will come maybe a year or so down the line, when there is some more movement in the economy and the environment on the demand side picks up, and there is some more policy clarity. That is when we'll see better movement in terms of the result company performance is concerned.
Rahul, for the PSU banking space, any signs of improvement in asset quality, or do you think now we would see the real picture, and that perhaps might not be that rosy? The reason I'm asking you this, because PSU banks have seen very big run up in the last 1 month on account of the whole expectation-led rally that the market has been witnessing. A reality check on the PSU space, what do you get?
See, as far as the PSU banks is concerned, the asset quality worries are still there, and clearly if you look at it in terms of the non-earning assets, that is restructured plus the NPAs, collectively they form nearly 10% of the overall asset base, And given that kind of scenario, your net interest income growth will be under pressure for the PSU banks. The asset quality, the economy is not yet picked up. The asset quality will continue to remain under pressure. However, going forward, our expectation is the gross NPA levels, which are at around 4.1% in the current year, they are expected to stabilize at the current levels going forward. And from here on, we are not likely to see any material deterioration. Here, the expectation is the growth in the next year is likely to perk up from the current levels. And also, we are seeing a lot of restructuring happening. So, to some extent, that would kind of come and help.
Okay. What about the technology space, Rahul? There's been a lot of fear of late, particularly after Infosys announced that perhaps they might be able to do just at the lower end of the guidance. TCS also sounded a little cautious when they spoke to analysts and flagged off some concerns, or particularly on the domestic front. The orders they have bagged onto the domestic market perhaps are not moving as they would have wanted. Then we have HCL, Wipro, which are playing catch up to the big ones. How do you see the IT sector performing in terms of earnings?
As far as the IT sector is concerned, clearly most of the earnings are actually dependent on how in the current year, at least Q4 will be dependent on year what has been the rupee movement. Clearly that has been a big positive. You are likely to see a strong healthy growth in top line. However, there are these warnings as you mentioned, but going forward on a structural wicket, if we look at the longer term over the next 1 year or so, we believe the global economy recovery will continue to support overall revenue growth for these entities even going forward. And the cost competitiveness argument that India offers will continue to ensure that some of these entities are very competitive in the global market and the revenue growth remains healthy.
What about the pharma space, Rahul? This space is not entirely cheap when we talk about valuations, but it's been promising stable returns. I think that's the reason why steady earnings, that's the reason why the street has had a big liking for the pharma space. We've seen signs of consolidation. It was 2 days back when two of the largest pharma companies in the country are going to come together, Sun going to acquire Ranbaxy in an all-stock deal. So M&A is still continuing. That means that valuations obviously are enticing in this space. Would it be backed up by good quality earnings once again?
As far as the earnings are concerned, on the pharma space is concerned, we expect continued generic growth to drive revenue growth for all the top companies. And given that backdrop, our sense is even going forward in the coming year, the revenue growth will remain healthy. The dollar revenue growth expectation will be in the 12 to 14% range. At the same time, margins will be quite attractive even going forward. So given that backdrop, our sense is the pharma space will continue to look strong. However, there are these concerns as we've seen in case of some companies with US FDA alerts. Barring those companies, as a whole, you should see some healthy growth and in both revenues as well as profitability for the pharmaceutical entities.
Okay, just before I let you go, let's talk about the mid-cap space, the mid and the small cap space. Now, this space has seen tremendous amount of volume activity and tremendous amount of price appreciation in the last 1 month. Obviously, it's playing catch up to the entire market move at this point of time. But, when you look at these mid-cap companies, small-cap companies, that's where the bulk of the pain has been felt in the last 3 years. Huge amount of leverage, interest rates seeing no signs of easing up. They've been hit hard by rising input costs. Demand has taken a beating. So these mid-cap companies have been the ones that have been really under pressure. Their recent stock price move, do you think their earnings will be able to justify this? Or do you think mid-caps and small caps is where we might face most of the pain as far as earnings are concerned?
See, clearly, as far as the mid-tier companies are concerned, the performance is going to lag the top-tier peers. Even in the last quarter results we saw, clearly your top-tier companies were able to withstand the pressure in the market much better. They have better brands, they have better pricing power, and it has been clearly visible in there has been a stark difference in performance of the larger companies versus the smaller companies. And we still believe, at least for Q4, the environment is still not very good for you to see sharp improvement in your earnings. And also, as you mentioned, leverage related issues continue to peg a lot of these companies, especially in the construction related spaces as well as the infra related spaces. So given that backdrop, a substantial improvement in performance is unlikely, and many of these balance sheet issues will continue to linger. And as we go forward, one would need to see how the environment evolves, how the policy environment evolves, how the new government comes into force, and what are the action points that happen. So clearly this space, earnings will be still vulnerable.
Okay. All right, Rahul. Thank you so much for dropping by, sharing with us your analysis on how to look at Q4 numbers. Is always a pleasure chatting with you. Let's take a break. We'll come back and resume coverage of the markets.